Well, it's a real pleasure to be here. The topic, obviously, the future of Europe, is a rather big one. And I'm not going to actually solve the issue completely. I'm going to begin, though, by taking a moment of reflection backward. In the decades since World War II, and even before, Europe built an economic and social system that delivered growth that was reasonably well shared. And in the years before the crisis that we're now confronting, it resulted in countries with among the highest welfare indicators in the world. I chaired an international commission on the measurement of economic performance and social progress, and one of the main messages of our commission was that GDP is not a good measure of well-being. There are a whole variety of other measures that are better, and in terms of these other measures, at the top of the list, well at the top of the list, we're all European countries. For instance, the UNDP has a measure called Human Development Indicators that focuses not just on income, but on education, on health. And the top countries performing, the top 10 countries, we're all European countries. If we go back even further, Europe was the source of the Enlightenment, a set of ideas, a set of values, which has been transformative, a set of ideas that really led to the increase in standards of living that have marked the last 200 years. People forget that for actually thousands of years until around 1800, standards of living around the world remained almost constant, barely perceptible increases in standards of living, literally for thousands of years. And then in the last 200 years, things have changed dramatically. So that the average citizen has a higher standard of living in many respects than the people at the very, very top did 500 years ago. And behind these transformations were simple ideas like the Enlightenment. Well, many of you take these, I'm sure, these basic ideas for granted, but I come from a country where almost every day we have to relitigate the Enlightenment. And having to do that, one should not take it for granted. Just to give you one example, there are large fractions of the American population that still do not believe in the existence of global warming, let alone that what our economic activity has contributed to the increased concentration of carbon emissions, carbon and greenhouse gases, that are leading to the warming of our planet and climate change that threatens us all. What's interesting about this, and I mention this because it links the nature of our society to economics and our ideas, it's not just a matter of education. Many of us had assumed that the more scientifically informed, literate individuals in our society would believe more in climate change. But if you do a regression, you relate the degree of scientific background and the belief in climate change in the United States, and we are the only country for which this is true, it actually goes the wrong way. And you might ask, what is the reason for this? And it turns out very simple. America has become a very divided society. And among part of our society, more conservative, one of the political parties, there has grown a belief that climate change is a hoax. And the result of that is that better educated people are able to reconcile their mind to between the facts and what they want to believe. So that in the Republican Party, the dominant view is that climate change is not something that we have to deal with. And so that's one of the reasons why it's been so difficult to deal with it. I emphasize this because I think in Europe, there is sometimes a tendency to forget the strengths that are at the core of Europe as they're going through what can only be described as a very bad patch. They're going through a difficult period. There's recession. Europe is just emerging now from recession. But even as it emerges, the average unemployment rate is around 12%. The youth unemployment rate is around 25%. And several of the countries in Europe are in depression. Now, it used to be, when I was at the World Bank, in the midst of the East Asia crisis, we were told by people in the U.S. Treasury, I was chief economist of the World Bank at the time, we were told by people in the U.S. Treasury it was impolite to use the word depression. In fact, they said it was impolite even to use the word recession. It made people feel depressed. So we started saying Korea was having an R, Indonesia was having a D. 40% of the people in the main island of Java were unemployed. There's no other word that you could say, but it was having a D period. But that, of course, didn't change the reality. The fact is that Spain is in depression. The fact is that several of the other countries in Europe are in depression. The magnitude of the economic downturn is actually greater than in the Great Depression. With the exception of Germany, I should say Switzerland, I'm talking about the EU here and the Eurozone. With the exception of Germany, almost all the other countries have a level of per capita GDP adjusted for inflation that is lower than it was 2007, 6 years ago. So not only has there been no growth, there's actually been decline, but even Germany has not been a success. Over the last, since 2007, the growth rate has averaged around 1%. In normal times, you said a country growing at 1% is a failure. And it's even worse than that. For the bottom 40% of Germany, their incomes have been declining. So again, not something that we would call a success. And that's why, as Ernst mentioned, when I was at Davos a few days ago, I was actually a little bit astounded at the cautious optimism that was universally shared in Davos. I could understand the relief that the European economy is at last emerging from a recession. It's obviously better to grow, say, at 1% than to decline at 1%. You don't have to have a PhD to figure that out. But that's not very good. With population growth, it will take years to recover GDP per capita to the level that it was before. Alan Greenspan once described what was going on in the United States as irrational exuberance. I think what I saw in Davos was irrational optimism. So the question being debated in many quarters is the following: what is the cause of these weaknesses, and what can be done about it? Some have suggested that the basic problem is a problem with the fundamental European economic model. Some have suggested, for instance, that the problem is with the welfare state, the European welfare state, the European social model. Actually, the head of the ECB makes that kind of a suggestion in an interview with the Financial Times. Some have suggested that there's less dynamism in Europe. because sometimes role of corporatism. But I think that those analyses are wrong. If you look around Europe, what you see is that the best performing economies in the world are within Europe. Among the best performing economies are those like Norway, Sweden, Austria, Switzerland. In fact, if you look at alternative measures of performance, you can see that these countries are performing actually much, much better than, say, the United States. Let me just digress for a moment and talk about these measures of performance. You know, before the crisis, a lot of people looked to the U.S. economic model. They looked to our GDP going up every year, and they said, that's an economic model that we want to imitate. And some countries did imitate it. Now, what we saw in the crisis of 2008 was the growth that we had was not sustainable. And that which is not sustainable won't be sustained. And our growth wasn't sustained. And after the crisis, you hear a lot less reference to the U.S. as a model that ought to be imitated. The point I want to make is that numbers like GDP don't tell you the extent to which that growth that you have is based on a bubble, on a credit bubble, on an asset bubble, and to what extent is it based on sustainable fundamentals. The U.S. growth was based on debt, on credit, on a bubble, and it was also based on the abuse of the environment. And so those are characteristics that are not captured in the GDP, but which mean that the growth can't continue. But there was something even more fundamentally wrong with the U.S. growth model, something that's become clear in the years after the Great Recession began. And that is, the growth in the United States is not widely shared. In fact, it's not only not widely shared. A lot of people say, oh, don't worry about that. There's trickle-down economics. You give money to the top, and everybody benefits. I wish it were true, because we've given so much money to the top that if it were true, everybody would be well off. But in fact, what's happened over the last 35 years is that we've had trickle-up economics. The median income in the United States today is lower than it was in 1987, almost a quarter century ago. Median means half above, half below. Most Americans have seen, for almost a quarter century, no progress. And actually, if you look at what I view as an important part of our society, men, things are even worse. Median income of a full-time male worker in the United States is lower than it was 40 years ago. I talk about this in the context of a talk about the future of Europe, because it highlights that the system, the economic system, has important consequences that are not well captured in a number like GDP, and that we have to be looking for other measures of performance. In terms of these other broader measures, several of the European countries are doing very well, in some ways much better than the United States, as I already mentioned. Even in the narrow measure of GDP, one of the reasons that GDP has continued to grow, as modest as it has been, is that Americans have had to work longer and longer hours just to get by. So if you look at a statistic that in some ways is more relevant, productivity per hour, how much do people produce per hour, The actual numbers that the growth in France, which is often castigated, is better than the United States. So the point I want to say is that in thinking about the future, one has to think about what kind of society one wants to create, what kind of economy one wants to create. The fact that the economic forces, the laws of supply and demand, operate roughly similar in all the advanced industrial countries, but the outcomes are very different in different countries, should have an important message. The nature of our economic system and nature of our society is as much a result of politics and policies as it is of the economic laws. So that even while there may be forces that are leading to increases in inequality, there are some countries that have managed to prevent that. For instance, Switzerland has managed to prevent an increase in inequality of labor income. And there are some countries that have actually reduced inequality. There are some countries that have succeeded in creating a fairer society, a society where there's more equal opportunity. Unfortunately, the United States is failing. I know all of you think of America as a land of opportunity, and it does give opportunity to some. It is certainly an important part of our self-image. But when economists talk about a country being a land of opportunity, they don't mean stories, anecdotes, individuals. They mean statistics. What is the chances? What is the likelihood of somebody making it from the bottom to the top, bottom to the middle, middle to the top, or from the top down? And the answer is that in terms of that, America has become the poorest country in terms of opportunity of the advanced industrial countries. Or to put it in another way, the life prospects of a young American are more dependent on the income and education of his parents than in other advanced countries, including old Europe. To put it still another way, it means that the most important decision a child has to make is the choice of the right parents. Well, all of this, I say, is because I believe very strongly in the future of Europe, and I think very strongly in a set of values which recognizes the importance of opportunity, that recognizes the importance of some of the values of enlightenment that I've been talking about. So what is the problem of Europe today? Well, basically the problem of Europe, and when I say Europe, I'm really going to talk about the Eurozone, which is a very large share of Europe. They made one little mistake. That was the euro. Now, I suppose it's not such a little mistake, but it's had enormous consequences. When the euro was created, it was recognized that the euro was not an optimal currency. An optimal currency is a currency that could be shared by a set of countries that could share a single currency. My colleague at Columbia, Bob Mundell, wrote a famous paper about what are the conditions under which countries could share a common currency. In fact, he got the Nobel Prize for his work in this area. Some people have suggested that they should withdraw the Nobel Prize now that euro looks like a failure, but that was a joke. The euro was a political project, and the political leaders understood that. The problem was that they didn't have enough political cohesion to really finish the euro project. In other words, to do what would be needed to make a single currency work. And part of the problem was that they misdiagnosed what would be required. So when you form a common currency, you take away two of the important instruments of adjustment. You take away, when one country gets a disturbance in one way or the other, you have ability to adjust the interest rate, you have the ability to adjust the exchange rate, and those adjustment mechanisms are extraordinarily important. One of the common views of the source of the Great Depression was the gold standard. And the gold standard took away the ability to adjust monetary policy and exchange rates. And so as countries were faced perturbations, disturbances, there couldn't be that adjustment, and the whole world sank. But it was not just that they took away these adjustment mechanisms and didn't put anything in their place. They led to a situation where effectively countries were borrowing in a foreign currency. And when a country borrows in a foreign currency, there can be a problem. In effect, they converted European sovereigns, European countries, they gave them the problem that we had seen over and over again in the emerging markets where we had sovereign debt crises. I know there's been a little confusion because of the rating agencies who's, I don't know why anybody pays any attention to what they say after what they did in the United States, but people do pay attention. And a couple of the sovereign rating agencies have raised questions about the United States, but let me assure you, the U.S. will always pay its debt. How do I know that? If you borrow money from the United States, you get a piece of paper, a bond, and what does that paper say? We promise to pay, say, $1,000. Well, how do I know the United States could always pay that? Because they just print those dollars. You know, you could imagine a temporary shortage of electricity and the printing press didn't work. But apart from that, it is inconceivable that we promised to pay you these little pieces of paper. You were foolish enough to accept that promise. And we will deliver those pieces of paper. But Greece can't deliver those pieces of paper. When it borrowed in drachma, it could deliver those pieces of paper called drachma. But now it promises to pay in euros, and it doesn't control the printing of the euros. That's done from Frankfurt. And so they can't get access to those euros. So in a sense, the euro created the potential of sovereign debt crises in Europe, a problem that had not been there before. In addition, Europe misdiagnosed what was needed for convergence. They knew that, going back to Mundell's theory, going back to this idea that what were the conditions under which currency, a group of countries could share a currency, they had to be sufficiently similar. They said, we need to have what is called a convergence criteria. They have to move together. But the only convergence criteria that they understood were macroeconomics, deficits and debts. And that analysis was badly flawed. But unfortunately, it continues to be flawed. If you look around the countries in crises, Spain, Ireland had a surplus before the crisis. Spain and Ireland had very low debt GDP ratios. The crisis caused the deficit in debt, not the other way around. And unfortunately, many of the European leaders still think that cutting back spending, attempting to reduce the deficit will cure Europe's problems. And as I said, was mentioned, this focus on austerity is like a suicide pact. No country, no large country, has ever recovered from an economic downturn through austerity. Now, it is true that every downturn eventually comes to an end, if you wait long enough. But the mark of a good policy is not whether things eventually turn around, but the depth and duration of the downturn. And the austerity in Europe has made the downturn excessively deep, excessively long. And unfortunately, when you look at countries like Spain and you ask, when will there be a return to normality? And by normality, I mean unemployment rates that should be in the range of anything acceptable. One can't see that happening anytime soon. In fact, if you look more closely at what Europe did, it adopted a framework that was designed, or the effect of which was to increase divergence rather than convergence. This was all well-intentioned, but it was based on either flawed economics on the one hand, or on the other hand, a failure to pay attention to certain essential details that make a very big difference. So let me just give you a few examples of what I have in mind. The idea of a single market made a lot of sense. The idea of a single market, say a single financial market, that money could move easily around a large number of countries, that it would lead to the more efficient utilization of capital. But that idea, the whole economic framework on which that was based, assumed perfect information and perfectly functioning markets. It didn't take into account the way markets actually function, didn't take into account the realities of imperfect information. So how did this play out? Well, let's go back to the crisis of 2008. It was failures in America's banking system that clearly led to the global financial crisis. And you would have thought, seeing how badly managed American banks were, how they had mismanaged risk, they had misallocated capital, money would not flow into the United States. But what happened in the early months of 2009 and the late 2008? Money went into the United States, which had been the source of the crisis. Was it because they believed that there had been an epiphany in American banking, that these guys who had been so reckless in their lending suddenly understood the principles of good banking? No, that was not what happened. Money was flowing into the United States for a single reason. The U.S. government had said, here is $700 billion, and if you need more, the tap is open. A couple $1 trillion. If you need more than that, there's even more. So America had shown the political willingness to do whatever it took to bail out the banks and make sure that the financial system survived, and it had the resources to do it. Money left countries without those kinds of resources. A general principle is that behind any country's banking system, inevitably, is the government. If you wanted to see this in a more narrow, wonkish way, what economists would say is that the correlation between the CDS spreads of sovereigns and the CDS spreads of banks of the same country are very highly correlated. Well, how does that translate now into Europe? If you have your money in a Spanish bank, who are you relying to bail out the Spanish bank if it has a problem? And by the way, you know that it has lots of problems because they lent into the Spanish real estate market, and there was a bubble in the Spanish real estate market like there was a bubble in the American real estate market, and so there's a lot of bad debt. Well, you look at the Spanish government, you say, is it able to bail out the Spanish banks? And the answer, obviously, is not very well. And the result of that is that money starts flowing from Spain into the strong countries like Germany. So the system starts diverging. Money leaves the weak countries and moves to the strong countries. I mentioned before the problem of austerity. So first you have public sector contraction, public spending is going down, but now you have the additional problem that because the banks are weak, they're not able to lend, and private sector investment, private sector spending goes down, and the combination of weak private sector and weak public sector spending is depression. So explaining the Spanish Depression is not very complicated. Unfortunately, it is an inevitable consequence of the structure of the Eurozone. It is not a problem of the structure of the Spanish economy. It is a problem of the structure of the construction of the euro itself. There are many other examples of where the flawed ideology, flawed economics has contributed to the problems in Europe. For instance, another one was, at the time, one of the fashionable ideas at the time that the euro was being created was that central banks should focus on inflation and only on inflation. That focus on inflation was a consequence of some very flawed economic models. We knew they were flawed before. When I say we, some of us knew. I think now it is widely recognized that these models were very badly flawed. But it actually ignored history. The reason the Federal Reserve was created, the Federal Reserve Board in the United States, our central bank in the United States was created, was not to control inflation. It was created because of a financial crisis. It was created to ensure financial stability. That was the reason we had a central bank. But at the time of the euro's creation, people forgot that simple lesson of history. And so they said the central bank should focus simply on inflation. And they put it in their charter, and so it has very little degrees of freedom. In the United States now, our central bank has a mandate to look at not just inflation, it's important, but it's only one thing, unemployment, growth, and financial stability. Now the problem is that if you're focusing on just inflation and the rest of the world or the United States is focusing on this broader mandate, you have a problem in Europe. Why? Because in the United States, we saw that we had this huge problem of unemployment. In fact, the Fed has focused explicitly on unemployment, and it brought the interest rates down and engaged in all kinds of activities to bring not only the short-term, but the long-term interest rates down. But the European Central Bank responded very slowly. And that, of course, meant that the exchange rate in Europe increased relative to the exchange rate in the United States. And that meant European exports were more expensive, and Europe faced a threat of imports from abroad. So monetary policy, at the center of the creation of the euro, was not designed to maintain a strong economy throughout Europe. There are other problems. For instance, I mentioned before that the problem of wide disparities within Europe, big differences in productivity between Portugal on the one hand and the most productive countries on the other. Well, it takes active policies to try to reduce those divergences. And we know some of the policies that actually can work. We call them industrial policies or productivity policies. But many of the policies that would have worked were proscribed by the restrictions in the euro, in Europe, restrictions that were well-intentioned, worried about unfair competition within Europe. But by restricting the industrial policies, particularly for the countries behind, they made it more difficult for those countries to catch up. So what I've tried to describe very briefly are some of the problems that were created with the euro. And that leaves us with the question, what can be done? What is needed? Well, there are things, I said in the beginning that the problem with the euro was that it was a political project in which the politics was not strong enough to do what was necessary to make the euro work. And I should point out that the problems of the euro were in a sense evident before the crisis. Some people say, oh, well, euro worked for a decade. But that's not right. Some of the problems in the euro framework were evident before, because the problems that we saw after the crisis were problems that were festering before. Capital went into Spain, helped create a real estate bubble, and the economic framework did not have the tools in order to restrain that kind of a bubble. So in some sense, there was a kind of irrationality, market irrationality, that when they eliminated the exchange rate risk, they thought they had eliminated all risk. And so if you look at the spreads, the risk premium that the markets associated with the money going into Spain, it was clearly an example of market irrationality. But in the era in which the euro was created, there was excessive confidence in market rationality, excessive belief that markets were self-adjusting and that markets on their own would work. So, to come back, what is needed to finish that project? Now, I had hoped when the problems in Greece broke out in January 2010 that would be an opportunity for Europe to show solidarity, to come to the help of Greece, to make the reforms that would make the euro work. But that was not what happened. Basically, assistance was titrated out, the minimum necessary to keep things going. And as you know, eventually there was a write-down in debt, but it wasn't enough, and then there was another write-down in debt, to the point, and meanwhile, austerity measures were tightened. The result of that is that GDP per capita in Greece today is about 25% below what it was. That's an enormous decrease. And yet, in spite of incomes and wages coming down, there's not more exports, or very little. There's not been the kind of resurgence that was expected. So what is needed? Well, basically there are three things. One is more of a fiscal union, ideas like Eurobonds. Why is that so important? Well, if you look at Europe as a whole, the Eurozone as a whole, the debt-GDP ratio is roughly that of the United States, perhaps a little better. The United States today can borrow at a negative real interest rate, that is a negative rate adjusted for inflation. And we have lots of projects public investments that yield high returns. If we borrow at a negative real interest rate, get a positive real return, we'll get more employment today and more growth tomorrow, and these will be self-liquidating loans. In other words, the growth will more than repay what we borrowed, and the strength of our fiscal position will be strengthened. Well, the same thing is true with Europe. If it borrowed together, it's not a question of Germany subsidizing other countries. It's that the market, when they see the strength of all of Europe together, will lower the interest rates, and at that lower interest rates, the countries like Portugal can repay their debts. If you have to pay an interest rate of 10 or 12 or 15%, obviously you have a problem repaying. If you have to pay an interest rate of essentially zero, it's much easier to repay your loans. And this is important because by lowering the cost of borrowing, it will free up more resources to stimulate the economies and return growth. I'll come back to that in a few minutes. The second thing that's needed is a banking union. I described before how, under the current circumstances, money naturally flows from weak countries to strong countries, creating an instability and divergence rather than convergence. But a banking union needs more than common supervision. It needs common resolution, common deposit insurance. Without deposit insurance, money will leave the weak countries and go to the strong countries. And unfortunately, while there is a growing consensus about not only the need for a banking union, but the need for a banking union with all three of the pillars I've described, the pace of creating that is out of sync with reality. You know, they're talking about 1, 2, 3, 4, 5 years, and that will mean a long period in which money continues to flow out of the weak countries towards strong countries, extending the depressions and recessions in the periphery of Europe. And finally, there's a need to replace the austerity that I described before with growth policies, with industrial policies, with public investment, with policies that will strengthen the economy today and make the economy grow tomorrow. One of the real concerns is that while Europe has been dealing since 2008 with the euro crisis, the underlying problems that have given rise to weaknesses, not just in Europe, but the United States. In the United States, performance, you know, we're growing, but it is still the case that our GDP is about 15% below what it would have been had we not had the crisis, and that there is no hope of narrowing that gap, and the growth that we are having is barely enough to create new jobs for the new entrants in the labor force. So there's some common problems in both Europe and the United States and the advanced countries, and the crisis has meant that we have not been able to devote any energy to addressing these underlying problems that were in some sense masked over by the bubble that preceded the crisis. And there are three of these that I just want to mention very briefly. One is this problem of growing inequality in most countries around the world, but not all. Why is that a problem for economic performance? Well, we should be concerned about it in its own right, but it also, because those at the top consume a smaller fraction of the income than those in the bottom, total demand, aggregate demand, is going to be weak unless it's made up for in some other way. And the way the United States and many European countries have made up for it is by creating bubbles. But that's not a way that will work. That's a temporary palliative. It's something that won't work in the long run. Just to give you a flavor of the differences, that before the crisis, as a result of the bubble, the bottom 80% of Americans were consuming 110% of their income. Well, you can figure out that couldn't go on for very long. Well, the problem of inequality has actually grown worse in the United States. Just to give you a flavor of one number that captures, I think, a lot of what's going on. Since 2009, when the United States is officially in recovery, you listen to people in the administration, the recession is over, things are good. 95% of all the growth in the United States, 95% has gone to the top 1%. That has meant that the 99% at the bottom has not seen a recovery. Well, so the problem of inequality has actually gotten worse. The second thing is the need for structural transformation. Economies constantly have to restructure, but this is a period in which we have the need is even greater. We've had other periods in our history where we've had large needs for structural transformation. In the 19th century, 70% of all workers worked in agriculture. But then we had very high productivity growth in agriculture. It was a good thing, but it had a consequence. People had to move out of agriculture. So as I said, in the 19th century, about 70% of people were involved in producing the food that we needed. Today, it's 2 or 3% of the population in the United States and Europe produce more food than even obese societies can consume. But that move was not easy. People had to go from agriculture to get jobs elsewhere. And the jobs they found in the middle of the 20th century were largely in manufacturing. But now we're facing a similar problem in manufacturing. We're the victim of our success again. Manufacturing productivity has gone up enormously, so much so that global employment in manufacturing is going down. And because of globalization, advanced countries, United States, most of the European countries, are going to get a smaller share of that diminishing global employment. Again, that's in some sense good news, but the bad news is these people have to get jobs elsewhere. And there are many other kinds of jobs in the service sector, but the important lesson is markets do not manage this kind of structural transformation well on their own. There is an important role for government to facilitate this transformation. The U.S. government facilitated the transformation from agriculture to manufacturing in the middle of the 20th century. We did it partly as a result of World War II. We moved people to fight the war. We moved people from the rural sector to the urban sector. We trained them. At the end of World War II, we said everybody who had fought in World War II had the right to a college education. And since almost everybody had fought in World War II, all men had fought in World War II, it meant we gave universal access to education. We no longer have that access to education. We charge huge levels of tuition. Student debt is now in the United States over $1 trillion. If you get swindled by a private profit-maximizing school and don't get an education that is worth the money that you borrowed, you cannot discharge that debt even in bankruptcy. So those debts are a rope around your neck. So this just highlights the fact that there is, both in Europe and the United States, this huge need for structural transformation. In some places it's going well, but in others it's not. And finally, there's an important issue of lack of global aggregate demand related to problems of global imbalances. But to talk about that would be another hour. So I'll just mention it as examples of critical problems that we should have been talking about, working on, addressing in the last 5 years, 6 years, but we haven't. Let me conclude by returning to the theme of the talk, which is the future of Europe, and particularly the future of the Eurozone. What happens in the Eurozone is mainly a matter of politics, not economics. What I described before is a set of policies which could easily be undertaken, which, if they were undertaken, would clearly enable, I think, the euro to work. The question is, will the European politics, allow it? Economists have a very cloudy crystal ball, but when it comes to political forecasting, the crystal ball is even cloudier. So I'm not going to make a forecast about where European politics will take it. But let me just make 2 comments. One, I would have hoped that it would be a matter of European solidarity, that all the countries realize that these reforms are things that ought to be done. But if that basic solidarity doesn't suffice, I would have hoped it would have been clear, particularly to Germany, that it was in its self-interest to engage in these reforms. It has been one of the big beneficiaries of the euro. And that if the euro doesn't work, it will be one of the countries that will pay the highest price. Much is resting on the success of Europe. I think much is resting on the idea that these reforms will be made. As I've said, American-style capitalism has not been working for most Americans for a long time. I spent a lot of time in the Middle East, and they're debating in many of the countries, and not only in the Middle East, elsewhere around the world, what kind of capitalism, what kind of a market economy do they want? They know that socialism failed, and they're asking, what is a third way? Recognizing that the American-style capitalism has not delivered for most Americans, they're looking for an alternative. I think the basic economic framework of Europe is that model, and that it is only a little mistake, the euro, that has caused the problems facing Europe today. I think the European system, which is based on the belief in the Enlightenment, a belief in the rights and responsibilities of individuals, a belief in the importance of social cohesion and solidarity, and a belief in democratic principles, I believe it is absolutely essential that Europe's economic model be made to work. And I do hope that there is a success in doing that. Thank you.